Hello, today is Wednesday, the 17th of September 2008, and we had a return of selling here again today. Yesterday it looked like we had some encouraging signs, but I had warned that we're still clearly in a bear market. There's not a reason to buy, and that we have this pattern of lower highs and lower lows which continues. And realistically, it's just going to take a lot of time for this market to heal. Markets correct two ways. One is through price, the other is through time, and we're still experiencing the price portion of it. Where it goes on the downside is anyone's guess. I get emailers telling me, that the SPY is going to go down to 80 or 85, and maybe they're right, but there's going to be some tremendous bounces along the way, like we've seen in here. And the key is to not trust those bounces as long as we have a declining 40-week or 200-day moving average. That's the way I define a bear market in my book. And if you look in here at the green moving average, that represents approximately the 40-week moving average. When that is turning lower, it means you're in a bear market, and the only trades on the long side you should be doing are very short term, because they're counter to the primary trend. When the 40-week moving average, or in this case we're looking at months, so approximately nine months, when that's declining, we're in a bear market, and you got to expect rallies to fail, especially when they rally up to prior levels of important support or resistance. Yesterday we saw this market rally back up to this 122 level and the declining 5-day moving average. I said that maybe if it gets back above that 5-day moving average, we can be a little bit more encouraged in here, but you've always got to be alert for any and all possibilities. Earlier this year I had people sending me emails saying, why are you such a bear, you're anti-American, you're this and that. Now I've got people telling me that we're going to 85 or so. We'll let the market sort it out. What we have to do is focus on individual price action and what we're trading, because there's tremendous opportunity in this market with this volatility, but you have to be extremely disciplined and very quick. Look at this action in here. I mean, it was we had a gap lower again, and then the market rallied a little bit, and then the same sell-off, rallied back up to that daily VWAP, came back down, tested that, looked like it was going to go, and then it just crashed down at the end of the day. Defense wins the game. Money management is job number one. I don't know how many times I've said that over the last several years. You've got, go back and look at the archives on my blog and type in money management or anything like that, and you'll see that I say it almost every day. And when the market's rallying, people hate me for saying it, but you can't be complacent, because really we don't know what we're buying here. We have no clue what we're buying. The big institutions don't even know. The fundamentals are only as good as people tell us. People tell us all kinds of things that turn out not to be true in the end, and if we stubbornly hold on to our opinions, it's going to mean that we're going to lose a lot of money. And that's what's happening here for the people that can't adjust or haven't adjusted or don't believe in what's happening here. Only price pays. That's where your analysis should be focused, and cutting your losses, managing your risk through small position size, etc. The IWM, this market continues. Obviously, the bigger level was at 75, 76 level. Let me go back to the SPY for a moment, because I just want to put that Fibonacci back on as far as that monthly time frame goes. If we take a look at these lows from back in 2002 to these highs, we're down at that 50% retracement level, but it's like a moving average. A lot of people look at them and place a lot of significance upon it, but it doesn't mean it has to hold. We did see the 38.2% hold a couple times this year, and now we're down to the 50% retracement. It doesn't mean it's going to hold. We're in a bear market. You could have measured all kinds of Fibonacci's back in 2000, 2002, 2003, etc., and those levels broke down too. There were only potential levels where buyers may emerge. It doesn't mean it's a reason to buy. The only reason to buy is when prices move higher, and it takes a lot of time to get this 40-week moving average to flatten back out and start turning higher again. It's not something that occurs over the course of 1 or 2 days in a washout volume. There'll be some tremendous trading opportunities, but only for the people that can handle the risk and volatility and don't get chopped up in it. Back to the IWM, the Russell 2000, the big level of support obviously for this market is down near 64. lower. It looks like we're heading for a test of that level. Doesn't really seem like there's much reason to think it won't get down there, and it's been an important level on 3 separate occasions. The more time support is tested, the more likely it is to fail. A lot of people call that a triple bottom. I call it just a level of support. We'll see what happens, but we're getting down towards that range, and nothing could save the selling in here at the end of the day today. We saw that the market rallied strongly yesterday afternoon, and right up to that declining 5-day moving average. When it gapped lower, if you were long, again, I've been saying it's only a day trader's environment in this market, unless you have the ability, which I don't, to hold short and then see these huge moves up just completely wipe you out. I prefer to day trade it, and I talk from a shorter term trader's perspective. That's the game I think that should be played in here. That's the one that works for me. If you have a different way, then do what works for you. That's the key here. The semiconductors, they continued, obviously, like every other group, to get hit. They were down 3.7%, and again, these levels on the monthly time frame, going back to the 2002 levels, are looking like they're becoming more obtainable, particularly down near this $24 level and then near 21. There's no such thing as down too much when everyone's in a liquidation mode. It's only down too much when people stop selling, not when there's a certain PE or when the government says something, or when the chairman comes out and says anything. Can you imagine if the government didn't come in and so-called rescue AIG last night, what this market would have done? It's just it's a risky environment. The financials were down almost $2 in here today, 9.3%. So this 1975, we got back above it yesterday. Today we're back below. We didn't make a lower low in there, but I don't think you want to look at that as a reason to be encouraged by any means. I'm still thinking that we probably need to at least test this low here. We remain in a horrible downtrend, bear market, so the risks remain on the long side. It's really pretty much that simple. We make it a lot more difficult by looking at the shorter term action, but we're guilty till proven innocent. And this market was no different. We had a little rally here early on, then they crushed them. A little bit of recovery in here. Looked like they were going to try and hold on late in the day, but then another give up towards the end of the day. And you look at for instance, gold today. Gold was up 11%, biggest one-day gain ever. And this market, supposedly should have been going higher based on, flight to safety and that sort of thing. But for some reason, today was the day. Now, the trend has been lower, but obviously, and the best trade here for the last couple months has been the short trade. But this is, again, why the only thing that pays is price, and the only thing that you can do is manage your risk. If you were short gold, you could have fought it all the way up today, but when it broke this level here and made a higher high, it just obliterated the shorts in there, and a lot of people made money on the long side as well. A lot of people are getting back to break even in this, and I think that the volatility in gold is going to continue, and this is why, even when you look at technical analysis in this type of environment, and you look at, this is clearly a stage 4 decline. But what is this big giant rally in here? Well, it's something that just simply doesn't fit right now. So you go back to the only thing that matters, which is risk management. You cut your losses if you were short, and you don't fight it. It's better to be on the sidelines, as they say, wishing you were in, than to be in the market wishing you were out of it. And I think that's how the shorts felt in gold today, and how the longs felt in all these other markets today. The NASDAQ 100, we thought there were some encouraging signs yesterday, but not a reason to buy, as we still do have a declining 10, 20, 50, and 200-day moving average. On the 30-minute time frame, we rallied right up towards this little area in here yesterday, and let's drill down to a 10-minute time frame. We had rallied up to this level in here yesterday, right to the declining 5-day moving average. When the market gapped lower here this morning, we'll now magnify this to the 1-minute time frame. You can see that the buyers came in initially, it broke below that daily VWAP, and then the selling began in earnest. Tried to recover here late in the day. with about an hour to go at 3 p.m. That failed to hold, and then people just basically capitulated. It's going to be interesting to see what kind of open we have tomorrow. As if we look in here, you can see that this level of what has been important for this market at about $41 a share has clearly been broken to the downside. We still have this pattern of lower highs and lower lows, and every single bottom caller has been wrong in the NASDAQ, and someone will eventually get it right. At more of a matter of guessing than anything. But what we want to focus on is the gradual shift. Markets rally up to that 200-day moving average. The 200-day moving average flattens out, and then as it makes higher highs and higher lows, that's when you can say you're out of the bear market. As far as the Fibonacci retracement levels for potential support are in here. Again, the 50% retracement level is about $37, and that's also the level that we had taken here on this weekly time frame as far as a projected downside eventually. And again, I'm not going to make any estimations as far as when it can happen. Things are occurring a lot quicker on the downside than I had originally expected, but this gave us also approximately 37 on the downside. We're basically melting down here. It's impossible to pick a bottom with any accuracy. You can do it for 20-minute trades, 30-minute trades, but if you're looking to bet longer term than that, you're playing a game that goes against what the largest money on the planet is doing, and they're liquidating in here.